In the previous video, we learned what is marginal cost and what is marginal costing, what are the characteristics of marginal costing, difference between increment, determination of cost and profit under marginal costing. Revenue, this is sales revenue 80,000. Product cost. Product cost includes direct material 30,000, direct employee or labor cost 10,000, direct expenses 7,500, variable manufacturing overheads 2,500. All put together it is 50,000. Product cost 50,000. So when we reduce revenue of 80,000, product cost of 50,000 from revenue of 80,000, what we get is 30,000. It is called contribution margin. This is in accounting, it is otherwise called gross profit. See, if you remember marginal cost formula, marginal cost is equal to direct cost or prime cost plus variable overheads. That is what we said marginal cost. Here also the inventorable cost means nothing but marginal cost, because under marginal costing, costs and inventories are valued at direct expenses plus variable overheads. Now coming to period cost. Period cost includes fixed manufacturing expenses like depreciation, etc., and fixed non-manufacturing expenses like sales, marketing, salaries. All put together, total period cost is 20,000. Okay. So when we reduce 20,000 of period cost from contribution margin 30,000, what we get is profit. If you observe here, contribution is higher than period cost, so we got 10,000 profit. Suppose if contribution is less than period cost, then we get into loss. Okay. Now let us understand marginal cost equation. From the earlier example, variable cost is deducted from sales revenue, we arrived at contribution, and then from contribution we have deducted fixed cost, we arrived at profit. Okay, so if you have observed contribution, if contribution is higher than fixed cost, then resultant will be profit. If contribution is lower than fixed cost, the resultant amount will be loss. Okay, so to arrive backwards from profit to contribution, we have to either add or subtract profit to fixed cost to arrive at contribution. Okay, let us take the same example. 30,000 was my contribution, 20,000 was fixed cost, and my profit was 10,000. So to arrive at contribution 30,000, what we have to do? Fixed cost of 20,000 plus profit. If I do, I arrive at contribution. If suppose my fixed cost was 40,000 and my contribution was 30,000, I would have incurred a loss of 10,000. So in that case, to arrive at contribution, I have to deduct loss from fixed cost, so that my contribution will be 30,000. That you just remember, it will be useful while calculating PV ratio and all. Now coming to PV ratio. PV ratio is nothing but profit volume ratio. What is profit volume ratio? What is the percentage of profit over certain sales? Okay, the ratio can be calculated contribution divided by sales into 100. Why this is required? Because under marginal costing, contribution plays an important role, because fixed costs are ignored under marginal costing, only variable cost is considered. So this ratio is called profit volume ratio. Based upon this ratio, management takes a decision on either continuing or discontinuing a product or a business, because if this ratio is not able to meet the fixed expenses, then as we explained above marginal cost equation, then we get into loss, then there is no point in continuing the product, or they may take some other decision of expanding the sales or reducing the cost, so in order to meet the contribution ratio or PV ratio. Okay, suppose if there are two levels of output and we have to decide which level is more optimal to us, then we have to calculate change in contribution profit ratio. That means, suppose if we are producing 100 units and uh, if we have to produce 150 units, then what is the PV ratio at 100 units? What is the incremental PV ratio for 50 units? Then we can, if the PV ratio is more than existing PV ratio, then we can definitely continue to produce. Otherwise, we need not produce because it is less than existing PV ratio. Okay. The mathematical calculation is explained below, because in certain sums they may not give contribution but they may give sales price and PV ratio. Then we have to calculate contribution is equal to sales into PV ratio. In case sales price is not given but contribution and PV ratio is given, then sales price is equal to contribution divided by PV ratio. It is only a mathematical expression of PV ratio, which is contribution divided by sales into 100. Cost volume profit analysis. As the name says, this analysis has three ingredients. One is variable cost, one is selling price, another one is volume. This particular analysis helps the management in providing certain critical information for decision making, which impacts the profit by change in selling price, volume of sales, or variable cost. Okay, there are certain underlying assumptions while doing this analysis. One is that the profit and cost changes only because of change in volume of product or activity. It says only when you increase or decrease the volume, there will be change in cost or sales price. Otherwise, the sales price and cost will remain constant. This is one of the assumptions. And because this is under marginal costing, it assumes that all cost can be divided into fixed and variable cost, which is not exactly even. Semi-variable cost can be easily identified under fixed and variable. Okay, but practically it is not like that, but it is one of the assumptions. And next, the price of selling price of the unit and cost will remain constant for a given level of output and period. This is another assumption. Okay, only when these assumptions are true, this analysis will be useful. Otherwise, it may go wrong. However, this analysis helps the management in providing various information that is helpful in taking managerial decisions of continuing the business or discontinuing the business. Which are those importance of this analysis is the behavior of cost in relation to volume, that is sensitivity of cost. Suppose at what level of volume, what will be the cost of production. Okay, the sensitivity of cost with respect to volume of production or sales, and volume of production or sales where the business will break even. At what volume the production will be or sales will be equal to the cost. That means break even means where there is no profit or loss on the product or on the business. Okay, this particular analysis helps in determining what is the break even point also, and sensitivity of profit due to variation in output, like how we said cost behavior, profit behavior at volume, various levels of volume in order to decide about the product profitability, and amount of profit for a projected sales volume. If certain level of output is produced and sold, what will be the profit estimate, and similarly at if I need certain level of targeted profit, then what quantity I have to produce and sell. These are the important information which this analysis provides to the management for taking managerial decisions with respect to introduction of a new product or continuing of a new existing product or discontinuing of existing product. This is the very important concept, cost volume profit analysis. Hope you understood what is contribution, what is cost profit volume analysis, and what are the underlying assumptions of CVP analysis and its importance to the management in providing information. All these concepts are very important. It will be useful even after your CA exams. Like this video, share this video, and subscribe to my channel for further educational videos. Thank you.